Welcome to Blockchain Today, your weekly dive into the future of finance, tech, and decentralized innovation. Let's get into it.
Okay, so you know that synthetic dollar you mentioned?
Uh-huh.
This USDD thing?
Mm-hmm.
Yeah, that's really interesting. The idea that it's like truly crypto native
Right.
and like Ethena is trying to build this whole form of money.
Yeah.
That's pretty wild. So I think for this deep dive, we need to like really get into what USD is, how it actually works, and crucially, what makes it so different from stablecoins like the ones we use all the time, like USDC, USDT.
Yeah, for sure.
Because even in the overview, they mention like the risks are inherently different.
Right.
Which tells me this is not just another stablecoin.
No, not at all. I think what's so interesting here is how ambitious it is. You know, they're really trying to move past that traditional fiat backing and engineer this stable digital asset, but like using tools from the crypto space itself.
Right.
And right away they point to two key things: USDD, so that synthetic dollar itself, and then SUSD, which seems to be this globally accessible way to potentially earn a return on those dollars. And on top of that, they're talking about internet native yield right on their homepage. So you have to wonder, where is that yield coming from?
Right. Yeah. It definitely feels like there's a lot more to uncover here.
Oh, absolutely.
Okay, so let's start with the core of USDD as a synthetic dollar.
Yeah.
So unlike, a stablecoin like USDC, where it's basically an IOU for a US dollar sitting in a bank account,
Right.
USD takes this completely different approach. It's backed by these crypto assets, Bitcoin, Ethereum, Solana, those are the ones they specifically mentioned, and then it uses these short positions in futures contracts. Now let's break that down a bit. When we say short positions in futures, how does that actually keep USD stable?
So the real key here is this idea of delta hedging. It's like Ethena holds these crypto assets, let's say Bitcoin, for example, and at the same time, they're entering into a contract to sell that same Bitcoin at a specific price on a future date, and that's that short futures position. They're doing this with both perpetual futures, which don't have a set expiry date, and deliverable futures, which do. And the goal of all of this is to get what they call delta neutral stability. The easiest way to picture it is like a seesaw.
Okay.
So if the price of Bitcoin goes up, the value of their actual Bitcoin holdings, that increases, but the value of their agreement to sell that Bitcoin in the future at what's now a lower price, that decreases. So these two movements, ideally, they balance each other out.
I see.
And then on the flip side, if Bitcoin's price drops, well, their Bitcoin holdings, they lose value. But now that short position is actually becoming more profitable.
Interesting.
So it's all about trying to neutralize these price swings to keep the value of USDD relatively stable and pegged to that dollar.
I love the seesaw analogy. So it's this constant back and forth.
Exactly.
But I noticed the overview also mentioned these liquid stablecoins like USDC and USDT playing a role too. So how do those fit into this whole delta hedging picture?
You know, that's actually fascinating. They seem to serve a couple of really important functions. First, they can just make the whole hedging process way more efficient. Depending on market conditions and what's happening at a specific time, using those stablecoins as collateral or even just to manage positions within the futures markets might be the most effective way to do it.
Right.
But then secondly, and this is pretty interesting, they can act as a sort of safety net.
Okay.
Especially if we see those conditions in the futures markets becoming less favorable. Maybe the incentives to maintain those short positions aren't as strong.
I see.
So holding a portion in stablecoins provides this buffer in those situations. And then there's even the potential for those stablecoins themselves to generate some yield depending on where they're held.
Oh, wow.
And of course, that contributes to the protocol's revenue overall. So it's more than just hedging the crypto. It's the strategic use of other stablecoins, too.
It's a much more layered approach than I initially realized. Now, the overview does say USD is fully backed, but then there's that caveat, subject to the discussion in the risk section regarding events potentially resulting in loss of backing.
Yeah.
Almost like saying, yes, it's backed, but... So what should we really take away from that?
I mean, you hit the nail on the head. While the mechanism itself is aiming for that full backing by having those assets and those offsetting futures positions, that disclaimer is huge. It's a reminder that there are definitely scenarios where that intended one-to-one backing could break down.
Right.
It's not like holding fiat in a bank account that's highly regulated.
Right.
This whole model depends on smooth, functioning crypto markets and derivatives, and there are a lot of events that could throw things off. So while full backing is the goal, maintaining it is much more complicated, and that means there are more potential risks.
Okay, so we can't just assume it behaves like a traditional stablecoin.
Yeah.
Got it. So moving on, we've got USD as this synthetic dollar working hard to stay pegged. Now, what about SUSD? They describe it as a globally accessible dollar savings asset.
Yeah.
What's the key difference there for someone actually using this?
Well, if we go back to that whole internet native yield concept,
Yeah.
SUSD is essentially what happens when users decide to stake their USD.
Okay.
So the main appeal is the potential to earn rewards that are generated by the protocol's revenue. It's like taking your USDD and putting it to work within that Ethena ecosystem.
I see.
But it's super important to remember that the overview very clearly states that this ability to stake USD and earn rewards is available exclusively for users in permitted jurisdictions. So it's not a feature that everyone everywhere can use.
Okay, got it.
Yeah.
So USD is the base synthetic dollar, and then SUSD is a way to potentially earn more on top of that through staking, but only if you're in the right location. Now, we talked about delta hedging as this core mechanism to maintain the peg, but are there other levers or things that Ethea uses to keep USDD anchored to the dollar?
Oh, for sure. One of the big ones is arbitrage.
Okay.
So if the price of USD on the open market, like on an exchange, for example, if it strays too far from that $1 target, there's this incentive for traders to step in and try to profit from that difference. And that actually helps to pull the price back in line.
Right.
So let's say USD is trading a little bit below $1. Someone could buy it at that lower price, and then theoretically, they could redeem it for slightly more than $1's worth of the underlying assets. Of course, assuming they have the necessary permissions to do that direct redemption.
Yeah.
But that buying pressure is going to push the price back up towards that peg. And if it's trading above $1, you'd see selling pressure doing the opposite, bringing it down.
It's like those classic market forces stepping in.
Exactly.
Now, for the average person, how do they actually get their hands on USD? And if they want to switch back to other assets, how do they do that? The quick links section gave us a little glimpse into that.
Yeah, so based on those quick links, it seems like the most common way for regular users to acquire USD is through what they call permissionless acquire.
Okay.
And that usually happens on decentralized exchanges, DXs, where you can trade other crypto assets. You have like USDT or USDC. So it's meant to be open and accessible to pretty much anyone.
Makes sense.
The other way is direct mint, where you're directly sending certain approved crypto assets to Ethena and getting USD back in return. But, and this is a big but, for most people listening, the documentation is really clear that this is subject to clearing KYC, KYB checks exclusively for approved market-making counterparties. So this direct minting isn't really for everyday users.
Really?
It's more for larger institutions who are actively providing liquidity in the market.
Got it.
And the details are probably in those supplemental USD terms and conditions for those specific entities.
So for most of us, it sounds like we'd be going through exchanges to get USD. What about getting your value back out? How does redemption work?
So the quick links also talk about direct redeem.
Yeah.
And that's basically burning your USD to receive those underlying assets. But just like direct minting, this also has that restriction. Subject to clearing KYC, KYB checks exclusively for approved market-making counterparties. And it's also governed by those supplemental USD terms and conditions.
Oh.
So it seems like even though you can trade USD freely on exchanges, interacting directly with Ethena to mint or redeem those assets has some limitations for most users.
Yeah.
So your main way to cash out would likely be just selling your USDD on the open market for something else.
Yeah, that makes sense from a regulatory and operational standpoint.
Yeah.
And then there's the whole stake and unstake USD option, which again, for eligible users, allows them to potentially earn rewards from the protocol by staking their USD.
Exactly. And it's super important to emphasize those jurisdictional limitations again.
Right, absolutely. Okay, so I think we've got a good basic understanding of what USD is, how it aims to maintain that peg through delta hedging and arbitrage, and how people can actually use it and potentially earn on it. But now, and we said this at the beginning, there's that extensive risk section in the Ethena documentation.
Yeah.
And while we're not going to go through every single risk factor today, it feels crucial to acknowledge that this isn't risk-free.
Of course.
And these might be different types of risks than what we see with traditional stablecoins.
Absolutely. The fact that they're calling them inherently different is a big deal.
Right.
Because this model relies on the connection between spot crypto assets and derivatives markets. There are types of risks that just aren't as prominent with fiat-backed stablecoins. Like, what about liquidity in those derivatives markets?
Right.
What if it suddenly becomes really difficult or expensive to maintain those hedging positions? Then there's the potential for huge volatility in the underlying crypto assets, which could totally impact how well the hedge works. And we can't forget the operational risks involved in running such a complex system across multiple exchanges. So we won't get into all the details now, but for anyone listening, taking a close look at that risks section and their general risk disclosures, that's really crucial.
That sounds like essential reading, for
Yeah.
sure. It's good that they also provide a bunch of other resources too, like FAQs, region-specific terms and conditions, and even video guides on things like buying and staking.
Yeah,
It seems like they're really trying to give people the information they need.
I think so. And they even mention real-time dashboards, which suggests a certain level of transparency. Users can potentially see some of those key metrics of the protocol's operation,
Right.
and that's really valuable for assessing its health and stability.
Definitely. So just to sum everything up for this deep dive, USD is this new synthetic dollar with a pretty big goal: to be true crypto-native money.
Right.
And they're trying to achieve stability through this complex delta hedging strategy using cryptocurrencies like Bitcoin, Ethereum, and Solana, plus those short positions in futures contracts. And then on top of that, you've got SUSD, which offers potential yield for users in certain jurisdictions who are staking their USD.
Yes, and it's really important to remember that while this new approach might open up some interesting opportunities, it also comes with its own unique set of risks that are directly tied to the complexities of derivatives markets and the volatility that's just built into crypto assets. This is a completely different game compared to those stablecoins that are simply holding fiat currency.
Couldn't agree more. So on that note, here's a final thought for everyone listening. Given this huge ambition to create internet money using these sophisticated financial instruments, what kind of wider impact do you see this having on the whole crypto ecosystem? And what new questions does this deep dive into USDD raise for you about the future of digital currencies? There's certainly a lot to think about.